welcome back to my channel. Now, I know a lot of the videos that I put out on investing are about long-term investing, because usually we're investing for a goal like retirement or our kids' college fund or buying a home one day, which means we're really investing with that long-term mindset. What about our short-term goals? What if we just need a place to park our cash for a few years until we need it while ensuring that money retains its value? Now, obviously, two natural places to put that money is in a high-interest savings account or a GIC, but what about ETFs? In this video, I'm going to share some other options that you may not know about to park your cash for your short-term goals that offer growth potential, but are much lower risk than, say, investing in the stock market. But before diving in, I want to say a big thank you to BMO ETFs for sponsoring this video. Now, in case you don't know, BMO ETFs has a ton of amazing educational content on ETFs, some of which we will be discussing in this video, and you can find it all on etfmarketinsights.com or their ETF Market Insights YouTube channel. I'm going to link to both in the description for this video. And FYI, I'm actually in a few of their YouTube videos, so make sure to check them out. I will link them below. So to get started, I think it's really important to talk about inflation for some context. For many of us, especially if you're a millennial like me or a Gen Z, up until 2021, you may have only ever experienced a period of stable and low inflation, which looks like an inflation rate between 1% and 3%. Now, stable inflation is a good thing. This is what we want because it means a stable economy. But unfortunately, inflation started to climb above that 3% rate in April 2021. And then it continued to rise and then peaked in June 2022 when it hit an inflation rate of 8.1%. Now, in order to quell inflation, the Bank of Canada had to raise its overnight rate, which is the rate that financial institutions in Canada use to lend and borrow from each other. Now, if the overnight rate goes up, these financial institutions subsequently pass on that higher cost to their customers in the form of higher interest rates on their debt products like loans, lines of credit, mortgages. But on the positive side, they do also raise interest rates on savings accounts and GICs. So on the one hand, it gets more expensive to borrow, but on the other hand, there is more incentive to spend less and save more, which are the two actions that we need to get inflation back down. We saw this exact thing happen when the Bank of Canada made its first rate hike in 2 years in March 2022. Soon after this happened, you likely saw some better rates being offered on savings accounts and GICs, which may have looked like a good thing because for so long, the rates on savings accounts and GICs were super low. And ever since then, I've been getting a ton of questions about whether it makes more sense to get out of the stock market, which has had very poor returns this year, and move instead to something low volatility and safer like a savings account and a GIC. Well, my answer is always the same no matter what's going on with inflation. First, what is your goal for the money? And second, is the rate being offered to you above inflation? Because even though a lot of the banks out there are offering better interest rates, often these rates are still below or not even matching inflation. And that's where so many people are making some big mistakes with their money. They're just looking at the higher interest rates and not comparing them to inflation. If the rate isn't matching or exceeding inflation, your money is losing value. That's why it's so important to know your options. There are different places that you can park your cash other than a savings account or GIC that offer higher interest rates, such as money market ETFs or short-term bond ETFs. So just to be really clear, it only makes sense to invest in these types of ETFs if you are just looking for a short-term place to park your cash. These investments do not make sense for any kind of long-term investing like retirement because you just will not earn the returns that you need in order to achieve that big lofty goal. Instead, I would suggest watching some of my previous videos that I did on broad market ETFs and asset allocation ETFs. I go in depth about how to invest in these types of ETFs for long-term investing, and they are literally the types of ETFs that I invest in my own portfolio for my own retirement. With that said, my circumstances may be very different than yours, so it's always important to consult with a professional to give you that guidance and that advice that you need for your own personal situation. Now that we've cleared that all up, let's talk about some money market ETFs. As of me making this video, and I'm recording it in November 2023, the current inflation rate is 3.1%. So what that should indicate is that if you were looking for a place to safely park your cash, you want to make sure that you are going to earn 3.1% or above, and ideally above. So let's first take a look at ZMMK, the BMO Money Market ETF. Now, in case you're not really familiar with money market ETFs, they're simply ETFs that invest in fixed income with the goals of preserving capital and providing security when the market is turbulent, which is what we've seen a lot of this year. Now, with ZMMK, for example, what's inside it is a combination of high-quality short-term Canadian corporate and government bonds with an average term to maturity of less than 90 days. Right now, its annualized distribution yield is 4.9 4.93%, which means if you take the monthly interest payments the ETF distributes to you, annualize it for frequency, and then divide it by the current ETF price or net asset value, you'd get 4.93%. Let me tell you right now, I have a running list of some of the best high interest savings accounts in Canada on my blog, and I'll link those below. And there's only one bank that offers above 4% and only two that offer 4%. Every other account that I could find out there offers below 4%. So this fund could be a great place to park your cash to get a return that is higher than any high interest savings account right now, and also that is well above inflation. With that said, it's very important to remember that these distributions can change at any time. Now I know what you may be thinking, what about GICs? There are GIC rates that offer 5% and above, but here's the thing to keep in mind with those. Those are typically non-redeemable GICs, meaning you can't withdraw your money until it matures, which is usually a year or longer. One of the benefits of investing in an ETF like ZMMK is you're not locked in. It works just like a regular ETF. You can buy and sell it at any point during market hours, but also the interest rate on GICs is typically calculated yearly, but paid out at maturity. With a money market ETF like ZMMK, those distributions are broken up into monthly payments, so you get access to that money much more frequently. That's one of the biggest differences between a money market ETF and a GIC, the liquidity, or how easy it is to access your money. Now let's move on to short-term bond ETFs by taking a look at ZST, the BMO Ultra Short-Term Bond ETF. Now this ETF is very similar to a money market ETF, except for what's inside it. As you can see, you'll find that it only invests in Canadian government and corporate bonds with maturities ranging from 0 to 1 years, as well as some preferred shares. Its annualized distribution yield is also higher than ZMMK at 5.17%. But similar to ZMMK, because this is an ETF, it is very liquid. You can trade it anytime during market hours and thus access your money very easily, and you can also get those monthly payouts. But what if you want to get some US exposure? Well, there is a short-term bond ETF for that as well. For that, you may want to check out ZUS.U, the BMO Ultra Short-Term US Bond ETF USD units. So as you may guess, this particular ETF is only available in US currency, so it would be appropriate if you had USD in your account. This ETF is also very similar to ZST, except it invests in US government and corporate bonds with maturities ranging from 0 to 1 years, as well as some preferred shares. Its current annualized distribution yield is 5.27% and also distributes payments monthly. Though if you don't need those cash distributions and would rather have those payments reinvested into the fund so it can compound over time, you may be more interested in a slightly different version of the fund called the BMO Ultra US Short-Term Bond ETF US Dollar Accumulating Units. Now, one last thing, because this is actually pretty important when you are investing in ETFs for the short term. Make sure that when you're investing through a discount brokerage that you are taking into consideration trading fees, especially as you move in and out of these shorter term parking place ETFs. But with that, I hope you enjoyed this video, and I look forward to seeing any questions that you may have in the comments, so make sure to put them below. Make sure to continue learning about money market ETFs and short-term bond ETFs, or just ETFs in general, by going to etfmarketinsights.com or checking out the ETF Market Insights YouTube channel right after this. And also a big thank you once again to BMO ETFs for sponsoring this video. Thanks again for watching this, and I'll see you next time.